Monday, January 9th, 2023, Monaco 64, home of alternative economics and contrarian views. So today I have the pleasure of speaking with Clive Thompson again. We spoke for the first time back in November and then again in December, and Clive has proven to be very popular with the viewers. Clive, Happy New Year. Nice to have you back.
Happy New Year to you, Mario.
Thank you. And yes, we covered CBDCs and reset and the Fed's balance sheet. So today, I wanted to talk to you about your views on what are going to be the most important things in the coming year, or maybe even beyond 2023 for our savings, for economics, for the markets. We will try to skip politics as much as possible, and I know there's a lot going on there because but I feel like you probably do that a lot of it is distraction, and that we need to focus, of course, on safeguarding our assets and making sure that we fight inflation. I think that's always the most important thing, especially for the last 100 years plus.
I agree with you, Mario. I think politics is a big distraction, and I try to concentrate on what's going on in the financial world, because that's the world I've been living in for the last 47 years, 48 years, as I've been advising clients on managing their wealth. I don't do that anymore. I'm retired, and I can speak freely about my view of banks as well. But let's just talk about the big themes that are going on in the world for the next 12, 24 and beyond months. I think one of the biggest themes is the end of the pandemic, at least here in the West. It's raging in China right now, but here in the West, the pandemic is over. And I think that is going to change the way people work, the way people behave. A lot of people have tried new things for the first time ever. They've tried new ways of having their holidays. They've tried new ways of connecting to the internet or accessing programs to communicate with one another. And of course, we've got this work at home experience a lot of people have had, and they liked it and they want more of it. So I think in that respect, we're going to see ongoing changes in the way people work, the way people behave in their lives. And if I, by extension, look at real estate, commercial real estate, offices, as I see them, are now at least a third empty. I go to my local car park and it's not full anymore. But before the pandemic, you couldn't get a car in. Now I would say it's 20, 30% empty. This is where people park their cars by the railway station to commute into town. So there's clearly not as many people going into work today as there used to be. And the owners of commercial buildings must be wondering what they're going to do with all that empty real estate. So I think we're going to get a lot of hot desking, reduction in amount of space. So when these leases on properties come to fruition, it's quite probable that a lot of companies will be saying we don't need quite so much space to their landlords, and they'll be letting it go. So we'll have to see what happens to that space. Will it be turned into apartments, or will it just rest empty? But bottom line is, I think that's quite bad news for real estate, commercial real estate, office blocks in general for the next, well, I'd say for a very long period.
Yeah, I saw recently, I think late last year, Blackstone, they've stopped liquidations, withdrawals from their property funds. I saw recently BlackRock and others, like I think there's a UK M&G. So, and liquidating real estate or commercial property is not like selling gold or silver, which are the most liquid really form of money. It takes a while. So yeah, I agree with you there. And how do you see, I don't know if you follow the UK real estate situation. We've seen prices dropping the last few months, but I see that the government, on the other hand, is put like help out there, like in the budget from the autumn budget. We see that from April this year, people who are on universal credit, they're going to help on their get help on their interest only mortgage, and that's not just for people that have lost their job. So I think in the UK here, real estate is very important, and they're going to do the utmost to keep it going. And for me, I see that as being inflationary. What's your view on that?
Well, ever since the beginning of time, property has been a good investment for the long run. And if we take the UK in particular, but I think this applies worldwide, there's an awful lot of people expecting house prices to go lower. You can find the forecasts of 10%, 13% lower house prices everywhere you look. So I think a lot of people have withdrawn from the market as potential buyers, waiting for those lower prices, and they plan to come back and be a buyer when they can buy properties 13% cheaper or 10% cheaper. The trouble with that is, while they're waiting, the number of people who are looking to have a home of their own is growing. So we've got this bubble of growing potential buyers, all waiting for lower prices. And I think it's a question of which persons start to move first, because the early birds will get the prices when they're down a bit. But I don't think prices are going to go down anywhere near as much as people expect. Of course, we do have a problem with some people who are going to be renewing their mortgages now at higher interest rates. That will be hurting, and there'll be some properties coming onto the market. But we've got, at the end of the day, there's an awful lot of people who would like to buy houses at yesterday's prices. So I think that, yes, we could have a little bit of decline in house prices, but I don't think it's going to be quite as dramatic as many people are hoping. And my advice is, if you're thinking of buying a house, try and make a lowball offer now, because the seller is also expecting house prices to go down, and rather than wait, he might accept your lowball price, your lowball offer. So to house buyers, I say, don't wait, make a lowball offer and see if you get it.
Yeah, and the other thing that I look at is the how many ounces of gold you need to buy the average UK house. And I've done a video about this, and I used the nationwide data from 1953, and I think a good level in terms of gold would be below 100 ounces for the average house price in the UK. It's gotten down to 90. And the other thing as well, people think, yeah, my house, the value of my house is going up, but they seem to forget, for example, from the beginning of last year to now, the pound has gone from 140 to like 120. It's lost about 15% versus gold. So like you said, yeah, house prices might not drop in nominal terms as much, but in real terms, it will. And I think what you said there is good. There's a good strategy there to put a lowball bid or offer, if you want to call it that, and that the seller might accept it. And what about because there's a lot of people who do buy to let in the UK, and a lot of them have leveraged themselves. That's maybe a different story. Any views on that?
Well, I think when you leverage, you're in a dangerous situation, because there's a risk that interest rates might spiral out of control. At the moment, we've got the central bank sitting there as buyer of the last resort of government bonds, and for more than a decade, they've been effectively controlling interest rates by buying bonds from the Treasury, from the government, that nobody else wants to buy, which means that interest rates have been below where they would otherwise be. If the Bank of England decides to stop buying bonds, and we'll call that quantitative tightening, or if they can't buy bonds, and we'll come back to that maybe later, the government's going to have to sell those bonds into a market where there are no bids. And that could mean interest rates go much, much higher, and that will definitely hurt people who've got variable rate borrowings. So if you're doing a buy-to-let, I would certainly make sure that your contract is one where you've got the interest rate fixed for a number of years, maybe even stagger it into, I don't know if you're allowed to do this in the UK, we do here in Switzerland, we can stagger it into multiple tranches, where you have a sort of 5-year tranche, a 10-year tranche, a 15-year tranche, or 1, 2, 3, 4, 5, 6, whatever you want. But certainly I would say try and get your interest rate fixed, so you're not caught out by a sudden spike in interest rates. Having said that, the best type of property to own in the environment we're in is definitely buy-to-let. If we do find that we have some more draconian measures relating to for example, rent controls. They're not going to apply to buy. They're not going to apply to the. When I say buy to let, I beg your pardon, I meant Airbnb type properties. They're not going to. So the best type of property would be Airbnb, where you can get the tenants in and out every week and charge a new rent. But if you have a buy to let property, which is let on the long run, you've got to be a little bit fearful of more draconian rent laws, where they stop you putting up the rent, especially in an environment of high inflation.
Yeah, that's right. I think they did that in the States in the 70s in New York. We
Well,
spoke of,
we've had it in the UK too, if we go back in time.
I see. Yeah, yeah. So yeah, by Airbnb style. Yeah, that's right. So do you there's a lot of people, especially in the mainstream economists, the central banks, the politicians, saying that inflation now has peaked. It might have, the CPI might have peaked, but I don't buy it. I think it could go down, the rate of growth, maybe to 5 or 4%, but I see another wave after that because uh, it seems like uh, if the central banks are too hawkish and they try to bring the CPI, what they call inflation, down towards 2%, it's going to create like loads of trouble. And we saw recently Sunak, the prime minister here, say, "Oh, I'm going to have inflation, this year." Only because the Bank of England forecast it. What's your view on that? These forecasts and the fact that they're now saying it's peaked.
I look a lot at commodity prices on the futures exchange, and I can see that across the board, commodities and food commodities in particular are way below the peak price we saw in April, May, June, July last year. Things are off a lot, and that will feed through to the inflation rate over the coming months. So it's inevitable that we'll get a falling CPI for a while, but it won't be permanent. We mustn't forget that a lot of the costs which go into getting things out of the ground, like food, have gone up. The price of fertilizer is higher. The price of labor is higher. So it's not like the food prices are going to stay down forever. And so I think, as far as inflation is concerned, I agree with you. I think we will have a dip in inflation coming up now, but I don't think the government is ever going to get down to the sort of 2% inflation target that they've always talked about. It might happen very, very briefly, but I don't think that would last. So I think we're in for probably, if things stay the same, decades of inflation and decades of accelerating inflation.
Could you tell us how different, how an impact it has from going from like 1 to 2% CPI, what they call inflation, to 3, 4, or 5%? Because it might not sound a lot, but maybe you, having been a wealth manager, you could tell us how it impacts the returns on investments, and maybe what do you think are the best investments to hold in such an environment? It seemed that we saw that last year was the worst year for stocks and bonds, maybe in over 100 years.
Well, I've never been any good at telling you or anyone which is the best investment for the next 12 months, and I don't think anybody can. And I certainly see from your videos you don't claim to know that either. But I think in the long run, any investment which protects you against inflation, genuinely protects you against inflation, is worth holding in your portfolio. And by that, I would mean, broadly speaking, tangible assets. That would include equities, it would include property, it would definitely include gold and silver. But we can all find other things. It could be razor blades, it could be tools, it could be electricity generators, it could be a home extension. There's many things you can put your money into which will at least keep up with inflation. Obviously, as inflation does go up, the pressure is on for interest rates to rise. And where we are today, we have interest rates below the official rate of inflation. But I think as the official rate of inflation stays high, or higher than it's been for the last decade, I think that the pressure will be on for interest rates to rise accordingly. So whilst I accept the central bank can manipulate interest rates, and they'll certainly try to keep them down, I think there's going to be growing pressure for rates to rise, and they might spiral out of control if there's a loss of confidence in the currency. We saw that in the UK gilt market recently, where it went into a kind of death spiral until the Bank of England stepped in and saved it. But this, that kind of situation can happen over and over again. And I think if we look at one particular problem with the bond market, it's bond funds. There's an awful lot of money. A large percentage of bonds are owned by bond funds. Those bond funds, to some extent, to quite a big extent, are owned by retail investors. Of course, institutional investors hold them too. Now, where we stand today is bonds have dropped by, depends where you look, 20, 30%. And the typical investor, and I'm talking about the sort of people I was dealing with in my career, will be looking at their bond funds and saying, what's going on, Clive? I bought this 10 years ago. It was supposed to be a nice, safe investment. And here we are 10 years later. The price of my fund is lower than what I paid. And I don't think it's even covered the dividends I've received. Why are we holding it? And interest rates are going to go up. Inflation is going up. It's not keeping up with inflation. Sell it. So I think we're going to have people looking at their portfolios at the end of this year and asking themselves the question, what is the value added of the bond fund in my portfolio? And they're going to be looking for something else. So I think there'll be money coming out of bonds, out of bond funds, and there might even be a rush for the exit all at the same time, in which case you'll be selling into an empty market where you can't get a price or you can't get a bid. But let's assume that money comes out more gradually. That money is going to go somewhere, and I don't think it's going to go back into bank deposits. I think it's going to go into tangible assets such as the stock market or gold and silver.
Where do you see the stock market? Of course, the major banks on Wall Street, they always seem to predict it, the S&P higher every year. Is that where you see the S&P?
Well, I've been following the forecasts yearly for the last 47 years from the experts, and I'll say they are almost never right. As a general rule, the consensus view of what the stock market's going to do is wrong by 30%. Or sometimes even more. But the difference between the median forecast and the outcome is large. So we saw that this year. Last year, we saw them forecasting stock markets up about 7%, and it went down 20-something%. That's a difference of, well, certainly more than 20%. And I think they're going to be wrong this year. I see the forecasts are a little bit higher this year than they were last year. We're talking about 10-12% is the typical forecast. So if they get it wrong by 30%, we'll be seeing either plus 42 or minus 20, something like that. If you ask me, I think it's more likely to rise than fall, despite the higher interest rates that we might see. And I think the reason that it might rise rather than fall is the quantity of cash on the planet continues to rise, and people are certainly going, even though interest rates on bonds are going up, they're coming out of bonds. So I do think that the money's got to go somewhere, and I think stock market will be one of those places where it will go.
I see. Any idea of the percentage, or is that a bit too?
Well, and if they get it wrong, if the analysts get it wrong, as they always do, and if it's to the upside, I'm looking at a 30 or 40% rise.
Wow. Okay, that's interesting. Yes, and I think a lot of governments and like regulators in the West, they force pensions to invest in bonds because they consider that safe. Yeah, I think that's going to create a huge problem, don't you?
Well, certainly pension funds will be campaigning for more flexibility. I actually know the investment manager of one of Geneva's largest, possibly the largest, but certainly a very large pension fund it's part of the government for the government employees in a certain area. That he's basically saying we're stuck by law. We've got to invest something in government bonds or safe investments. We're down to the absolute minimum legal amount that we're allowed, but we're clamoring to try and find a way to get permission to do more. But obviously that permission isn't going to come anytime soon. He would like to buy more equities, he'd like to buy gold, he'd like to buy other things, property, instead of government bonds.
Yeah, and in the UK, for example, physical gold is not considered a financial asset, so you can't put that in your pension fund. You'd have to put like a ETF, GLD, which I don't think is ideal. Personally, I think people should try to uh, get away maybe from putting all their earnings into a pension and maybe putting it outside a little bit. I know you get like a kicker uh, if you're a higher rate taxpayer, a 40% kicker when you put it into a private pension. But I think they're probably going to do away with that as well. And we spoke, of course, a lot in our first two videos. Well, we spoke about the Fed's balance sheet and then CBDCs and people were very interested in the CBDC side. I saw that our interviews were used as clips for people pushing cryptocurrencies. Could you maybe clarify your view on CBDCs and whether you are? I don't think you are a crypto enthusiast. You're more of a gold and silver guy, right?
Well, again, coming back to the diversification, I don't think there's anything wrong with earning crypto, but perhaps I should just clarify: crypto falls into two camps. There's Bitcoin and there's everything else. A lot of everything else doesn't have value. I think Bitcoin is here to stay. And if Satoshi Nakamoto was still alive today, I don't know what he'd be saying, but I don't think he even in his wildest dreams thought that we'd be seeing Bitcoin at above $10,000. I don't think even before he died, I don't think he even saw that kind of level. But you know, it's gone way beyond his wildest dreams, and it's had countless dips and then come back again. So I don't think it's wrong for people to have a small amount of Bitcoin in their portfolio. So I'm not anti-Bitcoin, but I'm also not here to predict a future price. It's an asset which you should have because you don't know which way the cookie's going to crumble. And of course, it could be very useful in the event that we have a world where the governments are raiding the financial institutions and raiding your assets. And I think that is, if we get a currency reset, that is a risk. So in that respect, things like gold at home and Bitcoin, which are outside of the financial system, aren't bad investments.
Yes, and I covered cryptos and Bitcoin a bit in the beginning, like in 2016, 17 on the channel. Of course, I've always covered gold and silver, and I had to decide what am I gonna stick to, and I stuck to gold and silver. But one thing I used to tell my viewers with crypto is that yes, you need to use the exchanges sometimes to exchange some of the altcoins for Bitcoin or Ethereum, because Bitcoin is like the dollar a little bit. Um, for example, I put my videos on this platform called Hive and Steam It, and they're blockchain based, and I think they're good. It's not a Ponzi. They provide a utility, and I earn those tokens or coins, and sometimes when I accumulate a bit, I send them to an exchange, sell them for Ethereum or Bitcoin. Usually Ethereum because it's cheaper to move it around than Bitcoin. So what I'm trying to say here, yeah, these exchanges they've popped up in the last few years, and I think a lot of opportunists and you know, I don't want to use the word shysters. They've come onto the scene and they've made the space, the exchanges and everything like a massive bubble, and that they've lured in the people who don't know better, like the small investor, and they haven't told them, oh, you should have your crypto in a private wallet. And no, they said, have your crypto in our exchanges. We'll give you some interest, and you will be able to leverage your crypto as well, you know, 10 times. So I think, like you said, that's the problem. It's all the greed, the leverage. But yeah, and Bitcoin, like you said, could have some kind of utility in a world where they come after your assets, but make sure you have it in a private wallet, just like uh, don't own gold in an ETF because they'll come after that as well.
Well, you're absolutely right, Mario. Own it in your private wallet. We only have to look at what happened in 2022. We had Voya Digital, which went bust after allegedly claiming that the customer deposits were insured up to $250,000. They're being sued by the FDIC now for that. They're obviously bankrupt. We had Three Arrows went bust, crypto hedge fund. We had BlockFi, which had lent money to Three Arrows, went bust. We had this stable coin called Terra, along with its associated coin called Luna, which went bust when it turned out that Do Kwon couldn't. We don't know what he'd done, but I think the Koreans are now hunting him down to try and find him. And of course, we know what happened with FTX in the last month or two, when it turned out that customer funds were being used in ways which you and I wouldn't approve of, basically allowing a completely related company, but supposedly unrelated at the time, to gamble with their money. We at least five, probably there were a lot more than that, but there's at least 5 bankruptcies of crypto companies in 2022. And those who hadn't taken the advice to keep their wallets at home in their own name, keep their own private keys, probably had some money with one of those and lost it.
Yes, I was reading yesterday the Winklevoss twins. They own, I think, Gemini, and they're in a battle with Genesis because Genesis they've frozen funds, and these are all related to accounts where they've promised you an interest on these cryptos. So they're acting just like a fractional reserve bank, which was the purpose, the opposite purpose of Bitcoin was to get out of this system that we have, fractional reserve fiat currency banking. So I think that will help people understand how we see cryptos. So we could move now maybe into maybe the bank's balance sheets, because I think that's going to be very important. And we saw, I don't know if you saw back in November, I think the head of the Dutch central bank said they could use gold to reliquify their balance sheets. And I think that's going to be a big topic going forward, because I, like you, expect interest rates to keep rising and bond yields to keep rising. And maybe you could explain to the viewers how that will impact the central bank's balance sheet, because a lot of people have difficulty understanding bonds, the relationship between price and yield.
Okay, so I spent a lot of time looking at the Federal Reserve's balance sheet, but I think what we see at the Federal Reserve is, broadly speaking, replicated in all the other central banks around the world, because the situation is pretty much the same. First of all, I'd like to just comment on what I'm going to describe as false accounting on the Fed's balance sheet. I see two examples of that. The first one is the Federal Reserve over the last decade bought a lot of bonds at above parity, and they're carrying that as that surplus above parity as an asset. But we all know bonds have dropped by 20%. So if they had a bond, they bought it at 106, they'll be showing the bond is worth 100, and they'll be showing the 6 as an amortization to come in the future, so as an asset. But that 6 is gone, and that 106% bond they bought is now probably worth 96 or 86. So it doesn't exist, but it's still showing on the balance sheet, and they're amortizing it gradually over the life of the bond at the rate of at the rate of 1 billion a week. But that asset doesn't exist, and it never will exist, because the best they can hope for is those bonds are going to be redeemed at 100% in 5, 6, 7, 10, 20 years, depending on the life of them. The second problem, which is not really visible from an accounting point of view, is that the entire bond portfolio they hold will be worth a lot less than they paid for it. When I look at their balance sheet, you can see that more than half of the bonds, the treasury bonds they own, have a life of more than 10 years. I don't know exactly what the life is, but it could be 10, 12, 15, 20, even 50 years. Those bonds will be down a lot, and they continue to carry the bonds at cost, which is legal accounting, because they're held. The intention is to hold them to maturity, but it's not really legal accounting if they're held for sale. Now, the U.S. Federal Reserve has said we plan on having quantitative tightening, which means we're going to reduce our bond holdings, reduce our size of our balance sheet. So some of those bonds are held for sale, and therefore, if they're held for sale under accounting law, that loss should be booked as a current loss. They're not doing that yet. We'll see how the end of year balance sheet comes out, but so far, on their 4th of January balance sheet, which is not audited, they're not showing any loss on those bonds. Now, the loss on those bonds will have wiped out their capital countless times, as will the amortization assets that they're showing, which doesn't exist. The third type of dodgy accounting I'm seeing is the Federal Reserve is making losses. It's losing money at the rate of the week before last, it was 2 billion. This week it's slightly more than 2 billion a week. So it's 2 billion a week of losses, and it's built up around 20 billion of losses. That compared with a capital of around 40, 45 billion includes their reserves. That means that their reserves are already half wiped out, and we've got about 16 weeks to go before those losses wipe out the entirety of their reserves. But if you look at the balance sheet, you won't see those losses as a loss in the profit. You won't see it as a loss on the balance sheet next to the capital as negative reserve. They've tucked it away in their liabilities section as a negative liability. In other words, they're calling it an asset. So the losses they're made, they're calling an asset, and they explain why they've done that. They basically say, when we make that money back again one day, we won't have to pay it to the Treasury because we won't have any profits. So from their point of view, that's an asset. Obviously, that's gobbledygook accounting, and no company on the planet could get away with that type of accounting. So let's now move on to the problem that we've got coming. Those losses are going to get bigger if interest rates go up, because what's happening is the Federal Reserve is paying interest to its depositors, which are the depository institutions, basically banks and money market funds, at the money market rate, the current rate, which is 4.5% going on 5%. The bonds they bought over the last 10, 12 years will have yields of around 2%. And I've done the maths on this to check that that's right. So they're paying out 4.5%, and they're getting in 2%. That's a loss of 2.5%. And they're losing money hand over fist every week. Their losses are getting bigger, and there must be a dialogue going on between the Federal Reserve and the Treasury about what they're going to do about this. Obviously, the one answer would be to recapitalize the Federal Reserve, but the Treasury doesn't have the money. It can't even pay the interest on what it already owns to the Federal Reserve without borrowing more money from the Federal Reserve in the first place. So the only way out of this would be for the Federal Reserve to print some money, lend it to the Treasury, who will then give it back to the Federal Reserve, so the Federal Reserve's capital goes up. So the money would go around in a big circle, but it would be once again increasing the Federal Reserve's balance sheet, which is already blown out of all proportion beyond anything anyone could have imagined a decade ago. And it's obviously that when you increase the balance sheet, that is quantitative easing, no matter which way you look at it. It's increasing the money supply. So that is inflationary.
Here in the UK, I think when they created the asset purchase facility, and that's actually a private company, you can go on Companies House and look it up. The UK Treasury told the asset purchase facility, which is part of the Bank of England, that if you make profits, you pay it to the Treasury, but if you make losses, the Treasury or the taxpayer will make that whole. And I think that we've already sent 11 billion to this asset purchase facility. And you could argue we're not bailing out the Bank of England, we're bailing out a private company. Could they do that in the US? And can they keep doing that here in the UK? It seems just like a taxpayer bailing out the Bank of England through the back door.
They can. They can do it in the States. They could do it here. But at the end of the day, it's the taxpayer who's going to pay, either directly through higher taxes or indirectly through higher inflation. The money's got to come from somewhere. So I think the appetite for higher taxation is not, well, at least it's not high, but I do think we're going to have higher taxes. But I think the majority of it, the bailout will come from printing the money.
So yeah, printing the money. So with that, maybe we could talk about how one can buy gold and silver, and what kind of coins or bars that you recommend or that you buy yourself. We're not like advisors here, but I think that's important because a lot of people ask, what should we do? And maybe talk a little bit what you do in Switzerland and what people could do here in the UK. I know you're originally from the UK, so I'm sure you're aware of it, and I'll also pitch in.
Sure. So one of the reasons why people might want to own gold and silver physical coins in their house is the potential reset that we're going to get at some point in the next couple of years, probably this year, but it might come next year or the year after. When that happens, there'll be an awful lot of people who make windfall profits. They'll be in the right place at the right time. They'll be earning the right type of assets, or they'll just borrowed money at the right moment, and they'll make a lot of profit. And those people are going to be hated and despised by the people who missed out, who didn't make a profit. The newspapers are going to hate them, and the government's going to see them as an easy target for taxation. And the easy way to tax those sort of people is to grab a slice of their financial assets in banks, but they can't tax very easily what you've got in your home. And you can store an awful lot of value in gold. If one gold coin about the size of a 10p piece is probably worth a few £1,000s, at least a couple of, well, 1 ounce, as you know, is worth $1,800, £1,600. So you can have a lot of value in gold off the grid. And so I do recommend that people have something outside of the grid, because it won't be quite so easy to seize it, tax it if it's at home. Talking about the ways to invest in gold and silver, I think first of all, it depends on why you're doing it, and secondly, it depends on the amount of money you've got available. You can't keep hundreds of thousands of pounds of gold and silver at home without having some risks. The risk of robbery. People get to know about it. People suspect it. The people you're buying it from, when you buy the gold, they'll know it, and who knows if they don't tell their friends or tip off a person you don't want to be tipped off. So it's not a great idea to have a lot of gold and silver at home. So you've got to think about a safe place to store it if you have any sizable quantity. The second problem with physical gold and silver is there's quite a big spread between buying and selling it. I know, for example, that if I buy silver coins, I would be paying around 15% more than the silver price at the moment. I might get them a bit cheaper, but I know if I went to sell them back, the silver dealers, the gold dealers would probably pay me 10 or 15% less than the silver price. So there's a huge gap between the buy and sell price. Now, obviously, I don't recommend people sell back to a pawn shop or one of these places which say we buy gold. If you've got something to sell, a far better way is to sell it via one of the online auction houses. Obviously, we've got eBay and Marketplace and many other places like that. But here in Switzerland, we have something called Ricardo, which is probably the premier place for people buying and selling gold coins, silver coins, and you can buy them from to and from an individual, and it works on a trust system, so you do have some risks. But if you're dealing in very small amounts, you don't have to worry too much. The second way to buy gold and silver is through the paper market, and by this I mean paper certificates. I personally would prefer the ETFs which are issued by, can I say the name, Mario, or is that maybe not on?
Yeah, that's fine. Yeah.
Yeah, so there's the ZKB, Zürcher Cantonal Bank, which is a government-owned bank based in Zurich. They have ETFs for gold, silver, and other things, and those ETFs are physically backed with silver, Loco Switzerland. I would be a bit more nervous about holding an American ETF where the physical gold and silver is located in the United States. But certainly that would be a way of getting some exposure if you have large amounts of money and you don't want to have it all in physical coins or bars. If you're buying coins or bars, the advantage of bars is certainly if you're buying in the larger sizes is that you'll get much closer to the actual gold or silver price. But don't forget that in the UK and in Switzerland and some other countries you have VAT on the silver bars, but usually not on the gold bars. So bars are probably a more logical way to store high value items. But if you fear that the currency is about to collapse and you're going to have to buy a loaf of bread with an ounce of silver, you'd better have silver coins because they could be, you could have, as little as 5 or 10 francs in a silver coin, whereas even a small, very, very small gold coin is going to be worth about 300 pounds, which is, you can't go and buy a loaf of bread with that, but you can with if I take one of the old silver shillings in the UK, I don't know what that's worth now, probably worth 2 or 3 pounds now, but you can certainly get a loaf of bread, and was that a shilling?
That's a shilling, yeah. Yeah. It's
Okay,
like it's like the size of an old quarter.
yeah.
So it's probably, you probably have to pay about 10 pounds. You could probably have it. It's probably worth at least 5 to 10 pounds, I would say, in fiat pounds. Yeah, I think those are good to have. And this is also good, like a florin.
Yep.
That's a double shilling. So here in the UK as well, if you're gonna buy physical gold and silver coins, I recommend Coins of the Realm. Even though there's VAT on silver, there won't be capital gains on gold or silver if you hold it in Coins of the Realm. For gold, it's sovereigns and Britannias. Of course, governments can change the rules anytime they want, but they could come after your financial assets as well. And like Clive said, it's much harder for them to come after your possessions in your home.
When I was a child, we're talking about the early 1960s, I used to pull out of my mother's purse the pre-19, I think it's 57 in the UK, maybe 47, 47, I think, the pre-1947 coins. And I've got, I've got about 60 pounds worth of it at face value. Plus I've got a couple of bags of old English silver threepences, which are very, very small. I got that valued recently, and I can't remember the figure that it came out, but it was worth many, many multiples of the 60 pounds that it was worth back in the 1960s, which just shows how much the currency has been devalued.
Yeah, and I think for the viewers in the UK and anywhere else, because you can find these coins anywhere else, probably. In the up until 1919, all the UK coins, except for the pennies, of course, they were 925 silver, and then after World War I, they cut it down to half. So from 1920 to 1947, they had 50% silver. So yeah, the coins your mom had in her purse, they had half 50% silver, and that's probably why they're worth quite a bit. And the threepence, or 3 pence, whatever you want to call it, I guess the shilling is 12 pence, so it's a quarter of a shilling. I have some of these the threepence. I think if there is, and we think there will be some kind of currency event, even the threepence, you could probably buy some milk with it. They will come in handy, I think. And maybe just to finish off, your view on the CBDC, and whether it's going to run parallel as well, and whether it's going to solve any problems that we have.
Well, it's definitely going to come. and we're going to go into a test phase at least in 2023. The legislation to allow that to be regulated is contained in the Financial Services and Markets Bill, which is now on its second or third reading in the House of Lords. Then it'll go for the Royal Assent. And after that, it could go into the test phase or launch at any time. And I think that will come. The question which I've got is, will we have at the same time a currency reset? We're definitely well overdue for a currency reset. It might not come at the same time, because if they can launch the CBDC before we have a crisis, it could run parallel. But the minute we have a crisis and people are all running away from the money, they're going to bottleneck the amount you can move over to the CBDC, or simply not let you do it at all. Or they may just say you need permission. So the CBDC is going to come. I don't particularly like the surveillance aspects of it, but I don't see how we can stop it. There's 150 countries going to bring it in the next 24 months, probably. They're all researching it at the moment. So I think we kind of got to put up with it. It's not going to go away. And yeah, let's wait and see if that is also the time for a currency reset. I think there's a chance that it might happen at the same time.
Yeah, and in the US, I think during the FTX debacle in the beginning of December or November, sorry, that was during the actually during the election, the Fed was doing tests as well for the digital Fed coin or CBDC. So to wrap up, Clive, tell me if I'm right by saying that you think the most important thing to do for people who have some assets to protect, the first thing is to diversify within the financial system. Second one is to have some insurance outside the system, and third one, not leverage.
Yep. And fourth one, don't hold more cash or bonds than you really need to hold for your spending over the next few months or years, depending on what you see as your financial, whether you have a job or not. I limit your assets which are fiat dominated and go into tangible assets, whatever suits the individual. The other day, I thought I didn't need razor blades, but I saw a pack of 10 razor blades and the price was right. And I thought, razor blades are an expensive thing when you buy them. So I thought, okay, you know what, won't do any harm. I just take 20 or 30 pounds off the table, so I don't have it in my bank account, and I'll have it in razor blades instead. And but you could equally buy more expensive items like tools or electricity generators or anything you might need to use in the future. I would say if there's something you might need in the future, could be tinned food, buy it now. Don't keep the cash in the bank thinking you'll buy it later.
Yeah, my wife and I were having a decorator come in this week to redecorate the kitchen and the living room. Also, yeah, keep your assets like up to date. And I think it's a good exchange, exchanging cash for someone to come in and make your house look better. So, Clive, thank you again for coming on the channel, and I really enjoy speaking with you, and I'm sure the viewers also enjoy hearing from you.
Thank you, Mario, and once again, Happy New Year to you, and Happy New Year to all of your listeners.
Thank you, and to you too. Take care.
Bye-bye now.